Ladies and gentlemen, welcome back to the channel. The world stood still in 2008 as financial markets collapsed. These words echoed across news channels as red arrows flashed on stock tickers. Wall Street executives looked on in disbelief, and families packed their belongings, forced to leave their homes behind. The global financial system was unraveling, and no one seemed to know just how bad it would get. Television screens were filled with shocking headlines. Lehman Brothers declares bankruptcy, stock market plummets, millions face foreclosure. In each or just a matter of months, the world witnessed the worst financial meltdown since the Great Depression. The crisis wiped out trillions of dollars in wealth, devastated economies worldwide, and left millions unemployed. Entire industries collapsed, and governments scrambled to stop the bleeding with massive bailouts. But how did this happen? How did the American housing market trigger a global economic catastrophe? Could it have been prevented? And more importantly, could it happen again? In this deep dive, we'll unravel the origins of the 2008 financial crisis, from the risky lending practices that built a financial time bomb to the government responses that shaped the economy for years to come. We'll examine who was responsible, the impact on everyday people, and the lessons we've learned or failed to learn since then. Stay with us as we uncover the full story of the Great Recession. The road to the 2008 financial crisis. How? The U.S. economy collapsed in the years leading up to the 2008 financial crisis. The U.S. economy appeared to be on an unstoppable upward trajectory. The stock market was soaring, home ownership was at an all-time high, and financial institutions were making unprecedented profits. But beneath this prosperity, a dangerous combination of risky lending, financial deregulation, and unchecked speculation was creating a fragile system that would ultimately come crashing down. The housing boom. How it all started. At the heart of the crisis was the housing market, which experienced a historic boom throughout the early 2000s. Several factors contributed to this: low interest rates and easy credit. In the wake of the dot-com bubble burst, 2000-2001, and the 9/11 attacks, 2001, the Federal Reserve cut interest rates to historically low levels to stimulate economic growth. These low rates made borrowing money cheaper, leading to a surge in mortgage lending and a sharp rise in home purchases. Americans eager to own homes took on loans they might not have qualified for under stricter conditions. The American dream of homeownership. The U.S. government, under both President Bill Clinton and President George W. Bush, pushed policies to expand homeownership. Agencies like Fannie Mae and Freddie Mac, government-sponsored enterprises, GSEs, encouraged banks to lend to low-income borrowers. Lenders, eager to capitalize on the growing housing market, began relaxing loan standards, allowing more people to buy homes. Subprime mortgages, the ticking time bomb. Traditionally, banks only gave mortgages to borrowers with good credit and stable income. But in the 2000s, financial institutions started issuing subprime mortgages, loans given to borrowers with poor credit histories. These loans often featured teaser interest rates, low initial rates that would later increase sharply, leaving many homeowners unable to afford their monthly payments. By 2005-2006, nearly 1 in 5 mortgages was classified as subprime, creating a massive pool of high-risk borrowers. The role of Wall Street, the financialization of housing, the rapid expansion of subprime lending was fueled by Wall Street's hunger for profit. Instead of banks holding onto the mortgages they issued, they bundled them together and sold them to investors in the form of mortgage-backed securities, MBSs, and collateralized debt obligations, CDOs. Securitization, turning mortgages into investments. Banks sold thousands of mortgages to financial institutions like Lehman Brothers, Bear Stearns, and Goldman Sachs. These firms repackaged mortgages into MBSs and CDOs, which were sold to investors, pension funds, and hedge funds worldwide. Investors were drawn to these assets because they seemed safe and highly profitable. After all, the housing market had never collapsed before. The role of credit rating agencies like Moody's, Standard & Poor's, and Fitch played a crucial role in the crisis by giving AAA ratings to many MBSs and CDOs. This rating made these securities seem low risk, even though they were filled with subprime loans that would later default in massive numbers. Investors, believing these ratings, poured billions of dollars into mortgage-backed securities, setting up the conditions for a major collapse. Deregulation and lack of oversight. The U.S. financial sector had been loosely regulated since the 1980s, and major laws restricting risky banking practices had been repealed in the 1990s. The Gramm-Leach-Bliley Act, 1999, removed the Glass-Steagall Act, which had separated commercial banks that took deposits from investment banks that took risks. This allowed banks to gamble with customer deposits, fueling speculative investment in the housing market. The Commodity Futures Modernization Act, 2000, exempted credit default swaps, CDS, from regulation, allowing banks to bet on mortgage failures without oversight. The collapse. How the crisis unfolded by 2007, cracks in the system began to show as housing prices started to decline. The entire financial system, built on the assumption that home values would always rise, began to unravel. Rising interest rates and mortgage defaults. In 2004-2006, the Federal Reserve raised interest rates to curb inflation. This made adjustable-rate mortgages, ARMs, more expensive, causing millions of homeowners to default on their loans. Foreclosures skyrocketed, flooding the market with homes and driving prices even lower. The banking crisis and Wall Street meltdown. As mortgage defaults piled up, the MBS and CDO markets collapsed, leading to massive losses for banks and investment firms. Bear Stearns, March 2008, was the first major casualty, forced into a fire sale to J.P. Morgan Chase to prevent total collapse. Lehman Brothers, September 2008, a 158-year-old investment bank, declared bankruptcy, triggering global financial panic. The failure of Lehman froze credit markets, making it nearly impossible for businesses and consumers to borrow money. The stock market crash and economic recession. The Dow Jones Industrial Average plunged nearly 800 points in a single day, one of the worst drops in history. Companies cut jobs as consumer spending collapsed, leading to the worst economic downturn since the Great Depression. By the end of 2008, millions of Americans lost their homes, jobs, and life savings. The government's response, bailouts and reform. As the financial system teetered on the brink of total collapse, the U.S. government intervened with a series of emergency measures. The $700 billion bailout, TARP. The Troubled Asset Relief Program, TARP, authorized the government to buy toxic assets from struggling banks. Major institutions like AIG, Citigroup, and Bank of America were bailed out to prevent a total banking collapse. The Federal Reserve's intervention. The Fed slashed interest rates to near zero and injected trillions of dollars into the economy to stabilize the financial system. The Dodd-Frank Act, 2010. Preventing future crises. This sweeping financial reform increased oversight on banks, created the Consumer Financial Protection Bureau, CFPB, and restricted risky lending practices. The aftermath, a changed financial landscape. The 2008 crisis reshaped global finance, government policy, and public trust in the system. The Great Recession, 2008-2013, left millions unemployed and erased trillions in household wealth. Public outrage over Wall Street's role led to movements like Occupy Wall Street, 2011, demanding banking reforms. Banking regulations tightened, but debates over deregulation versus oversight continue to this day. Even now, the lessons of 2008 remain relevant. The crisis exposed the risks of unchecked financial speculation and the danger of assuming markets will always rise. Could something like this happen again? Have the financial reforms since 2008 gone far enough? Let us know your thoughts in the comments below. The housing bubble, the foundation of the 2008 financial crisis. The housing bubble of the early 2000s was the catalyst for the 2008 financial crisis, triggering a chain reaction that led to the collapse of major financial institutions, mass foreclosures, and a global recession. The crisis was fueled by easy credit, lax lending standards, and financial speculation, which created an unsustainable surge in housing prices. The housing market boom. How it all started in the early 2000s, the U.S. housing market experienced an unprecedented boom. Several key factors led to this surge. A. Low interest rates and easy credit. In response to the dot-com bubble collapse, 2000-2001, and 9/11 attacks, 2001, the Federal Reserve slashed interest rates to historic lows, around 1% by 2003. Lower rates meant cheaper borrowing, making home loans more accessible to a broader range of people. As mortgage payments became more affordable, demand for homes increased, driving housing prices higher. B. Government policies encouraging homeownership. Homeownership had long been seen as part of the American dream. The Clinton and Bush administrations pushed policies aimed at increasing homeownership rates, especially among low-income families. Government-backed agencies like Fannie Mae and Freddie Mac encouraged banks to issue more mortgages, even to borrowers who might not have previously qualified. C. The role of Wall Street and financial innovation investment banks like Lehman Brothers, Bear Stearns, and Goldman Sachs saw the booming housing market as a golden investment opportunity. They bought massive amounts of mortgages from banks, bundled them together, and sold them as mortgage-backed securities, MBSs, to investors. As demand for these securities skyrocketed, banks had an incentive to issue even more mortgages, leading to lax lending standards. 2. The rise of subprime mortgages. High-risk loans for high profits. At the core of the housing bubble was the rapid expansion of subprime mortgages, high-risk home loans issued to borrowers with poor credit histories. These loans were designed to make homeownership accessible to more people, but they contained hidden dangers. A. What are subprime mortgages? Traditional mortgages required strong credit scores, stable income, and a sizable down payment. Subprime mortgages were given to riskier borrowers who didn't meet these requirements. To attract borrowers, subprime loans often featured low initial payments but came with hidden risks. B. Adjustable rate mortgages, ARMs, the hidden danger. Many subprime mortgages had adjustable interest rates rather than fixed rates. Borrowers were enticed with low teaser rates for the first few years. Once the initial period ended, interest rates shot up dramatically, making monthly payments unaffordable. Many borrowers didn't fully understand these risks, assuming they could refinance or sell their homes before rates increased. C. No-doc and ninja loans, extreme lending practices. Lenders, eager to maximize mortgage sales, abandoned traditional safeguards. No-doc loans. Borrowers weren't required to prove their income or assets. Ninja loans. No income, no job, no assets. Loans were issued to people with no verified ability to repay. These reckless lending practices allowed millions of unqualified buyers to enter the housing market, driving home prices even higher. 3. The housing market becomes a speculative bubble. By 2005-2006, the housing market had turned into a full-blown bubble driven by excessive speculation and irrational confidence. A. The house flipping craze. Many investors and ordinary buyers began purchasing homes just to resell them for quick profits. TV shows and media glorified house flipping, making it seem like a guaranteed way to get rich. This frenzy further inflated housing prices, making the market even more unstable. B. The myth that home prices always go up. A dangerous assumption took hold. Housing prices will keep rising forever. Buyers took on massive mortgages they couldn't afford long-term, believing they could always refinance or sell at a profit. Banks, lenders, and even government agencies failed to see the warning signs of a potential collapse. 4. The collapse. How the bubble burst. By 2007, cracks began to appear in the housing market. As interest rates rose and adjustable rate mortgages reset to higher payments, many borrowers could no longer afford their mortgages. A. Mortgage defaults and foreclosures. Surge millions of homeowners fell behind on their mortgage payments as their monthly costs skyrocketed. Foreclosures flooded the market, causing housing prices to plummet. Suddenly, homeowners found themselves owing more than their homes were worth, a situation known as being underwater on a mortgage. B. The domino effect on Wall Street. Since banks and investors had massively invested in mortgage-backed securities, the collapse in home values caused huge financial losses. Institutions that held billions in toxic mortgage assets saw their balance sheets crumble. Bear Stearns, March 2008, was the first major casualty, needing an emergency buyout by J.P. Morgan Chase. Lehman Brothers, September 2008, once a powerhouse investment bank, declared bankruptcy, sending global financial markets into chaos. C. The Mai-Shi. Stock market and global economy crashes. The financial panic led to a stock market collapse, with the Dow Jones dropping nearly 800 points in a single day. Banks stopped lending money, leading to a credit freeze, which choked businesses and caused mass layoffs. The U.S. economy entered a deep recession, with unemployment soaring to nearly 10% by 2009-5. The aftermath and lessons learned. The 2008 financial crisis was one of the worst economic disasters in modern history, costing millions of Americans their homes, jobs, and savings. In response, the U.S. government took unprecedented steps. The $700 billion bank bailout, TARP. The government purchased toxic mortgage assets to stabilize the banking system. The Federal Reserve cut interest rates to nearly 0% to encourage lending and economic recovery. The Dodd-Frank Act, 2010, introduced new financial regulations to prevent reckless lending and speculation. Final thoughts. Could it happen again? Many lessons were learned from the 2008 crash, but some experts worry about new financial bubbles forming today in real estate, tech stocks, and cryptocurrency markets. What do you think? Are we heading toward another financial crisis, or have we truly learned from the past? Let us know in the comments below. As demand for housing surged, prices skyrocketed. Between 2000 and 2006, home prices in the U.S. nearly doubled. Investors, seeing an opportunity, rushed to buy properties, further inflating the bubble. Banks and mortgage lenders had little reason to worry because they didn't hold on to these risky loans. Instead, they bundled them together into mortgage-backed securities and sold them to investors, pension funds, and even foreign governments. The explosion of these financial instruments was made possible by decades of deregulation. In 1999, the repeal of the Glass-Steagall Act, a law that had separated commercial banking from investment banking since the Great Depression, allowed financial institutions to take on riskier activities. Banks were no longer just lending money. They were speculating in complex financial products like collateralized debt obligations, CDOs, which packaged together thousands of mortgages, including the riskiest subprime loans. These financial products were supposed to be safe, but the reality was far different. Credit rating agencies, such as Moody's and Standard & Poor's, gave top-tier ratings to these mortgage-backed securities, despite the fact that many were built on loans that had a high probability of default. As long as home prices kept rising, everything seemed fine. But the system was fragile. Once prices stopped climbing, the entire house of cards would collapse. Wall Street firms like Lehman Brothers, Bear Stearns, and Merrill Lynch played a major role in this speculative frenzy. These firms borrowed massive amounts of money to invest in mortgage-backed securities, betting that the housing market would never crash. Some were leveraged at a ratio of 30.1, meaning for every $1 they actually had, they borrowed $30 to invest. This extreme risk-taking meant that even a small decline in the housing market could wipe out their entire balance sheet. By 2007, cracks in the system began to appear. Home prices stopped rising, and borrowers who had taken on subprime loans began defaulting in record numbers. Mortgage-backed securities that had been treated as safe investments suddenly became toxic, and banks found themselves holding billions of dollars in assets that were rapidly losing value. Panic spread through financial markets, but the worst was yet to come. What had started as a housing market downturn was about to spiral into the worst financial crisis since the Great Depression. By 2008, the warning signs were impossible to ignore. The housing market had peaked, subprime mortgage defaults were rising, and banks were struggling to offload their toxic mortgage-backed securities. But even as financial institutions faced mounting losses, few anticipated the full scale of the disaster that was about to unfold. Lehman Brothers. The fall of a Wall Street giant. The collapse of Lehman Brothers on September 15, 2008 was the single largest bankruptcy in U.S. history, marking a turning point in the 2008 financial crisis. As a major player in investment banking, Lehman's aggressive expansion into mortgage-backed securities, MBSs, and collateralized debt obligations, CDOs, left it overexposed to the subprime mortgage market. When the housing bubble burst, the firm found itself drowning in toxic assets, unable to recover. Lehman Brothers, a financial powerhouse turned risk machine. A legacy of success, 1850-2000s. Lehman Brothers had a long history of financial innovation and success. Founded in 1850 as a cotton trading business, Lehman evolved into one of the most powerful investment banks in the world. By the early 2000s, it was deeply involved in securitization, bundling, and selling mortgages as investment products. It became one of Wall Street's biggest players in the mortgage-backed securities (MBS) market, riding the wave of the housing boom. The mortgage-backed securities and CDO gamble Lehman, like other Wall Street firms, heavily invested in mortgage-backed securities, MBSs, and collateralized debt obligations, CDOs. These were complex financial products based on bundled home loans, which were sold to investors as safe assets. Lehman bet big on these products, assuming that housing prices would always rise. This assumption was catastrophic because MBSs and CDOs were loaded with subprime loans, many of which were doomed to default. When homeowners started defaulting, the value of these securities collapsed overnight. Lehman was left holding billions in toxic assets that were suddenly worthless. By mid-2008, Lehman's balance sheet was filled with unrecoverable debt, and the firm had no way to offload its bad investments. The impact was immediate and catastrophic. Lehman's failure shattered confidence in the financial system, triggering a global panic. Investors rushed to pull their money from the stock market, leading to one of the worst crashes in modern history. The Dow Jones Industrial Average plummeted nearly 800 points in a single day, the largest one-day drop at the time. Other financial giants, including Merrill Lynch, AIG, and Wachovia, were on the brink of collapse, forcing emergency interventions to prevent further economic devastation. As the crisis deepened, the effects rippled far beyond Wall Street. Banks, desperate to protect their dwindling reserves, stopped lending, triggering a credit freeze. Businesses suddenly found themselves unable to borrow money for payroll or operations, leading to mass layoffs. Foreclosures skyrocketed as millions of Americans lost their homes, unable to keep up with mortgage payments. The global economy was unraveling at a terrifying pace. Facing the worst financial meltdown since the Great Depression, the U.S. government scrambled to contain the damage. In October 2008, Congress approved the Troubled Asset Relief Program, TARP, a $700 billion bailout designed to stabilize the banking system by injecting capital into struggling institutions. At the same time, the Federal Reserve took unprecedented steps, slashing interest rates to near zero and launching emergency lending programs to keep financial markets afloat. Despite these efforts, the economy continued to spiral downward. In early 2009, newly elected President Barack Obama introduced a massive $787 billion stimulus package aimed at jumpstarting economic recovery through tax cuts, infrastructure projects, and direct financial aid to struggling Americans. These measures helped slow the bleeding, but the damage had already been done. By the time the dust settled, millions of jobs were lost, over 10 million homes had been foreclosed, and the global economy had suffered a staggering $15 trillion in losses. The Great Recession had officially begun, and its effects would be felt for years to come. As the financial system collapsed, the impact quickly spread beyond Wall Street and into the lives of everyday people. The crisis led to an economic downturn that wiped out jobs, savings, and homes on an unprecedented scale. Families who had once lived comfortably suddenly found themselves struggling to afford basic necessities, while entire communities were devastated by foreclosures and business closures. The job losses were staggering. By the end of 2008, companies across multiple industries, banking, manufacturing, retail, and construction, were laying off workers in droves. In just over a year, the U.S. economy lost more than 8 million jobs, pushing the unemployment rate to 10%, its highest level in decades. For many, losing a job meant more than just financial hardship. It meant losing health insurance, retirement savings, and the ability to support their families. Long lines formed outside unemployment offices, and formerly middle-class families turned to food banks for assistance. At the same time, the housing crisis was hitting its peak. Between 2007 and 2010, over 10 million homes were foreclosed on, leaving families displaced and entire neighborhoods abandoned. In some areas, entire streets were lined with boarded-up houses, their former owners forced to move in with relatives or live in shelters. Even those who managed to keep their homes saw their property values plummet, wiping out years of accumulated wealth. As the crisis deepened, public anger erupted. People were furious that Wall Street, whose reckless financial practices had caused the collapse, was receiving massive government bailouts, while ordinary citizens were left to suffer. This anger boiled over into protests, most notably the Occupy Wall Street movement, which began in 2011. Protesters gathered in major cities chanting slogans like, "We are the 99%, to highlight the growing wealth inequality and the perceived corruption of financial institutions. Their message resonated with millions who felt abandoned by a system that seemed to favor corporations and the wealthy at the expense of the working class. The effects of the crisis were not limited to the United States. It quickly spread across the globe. In Europe, economies like Greece, Spain, and Italy plunged into recession, forcing governments to impose harsh austerity measures. Massive protests erupted as people fought against job cuts, pension reductions, and tax hikes. Countries that relied heavily on exports, such as China and Germany, also suffered as demand plummeted. In developing nations, the economic downturn led to rising poverty rates and political instability. By the time the worst of the crisis had passed, millions had been pushed into poverty, trust in financial institutions had been shattered, and an entire generation faced an uncertain economic future. The scars of the 2008 crash would linger for years, shaping policies, politics, and public attitudes toward capitalism, government intervention, and economic inequality. In the wake of the 2008 financial crisis, governments and regulators around the world were under immense pressure to prevent such a catastrophe from happening again. Public outrage over corporate greed, reckless banking practices, and the use of taxpayer money to bail out failing financial institutions led to a push for sweeping reforms. The response was a series of new regulations designed to increase oversight, protect consumers, and curb excessive risk-taking by banks. The Dodd-Frank Act, reshaping financial regulation. After the 2008 crisis, the Dodd-Frank Wall Street Reform and Consumer Protection Act was signed into law on July 21, 2010, by President Barack Obama. This sweeping legislation aimed to prevent another financial crisis by addressing the failures that led to the 2008 collapse. It was the most comprehensive financial reform since the Great Depression, targeting risky banking practices, lack of oversight, and consumer protection. Why was Dodd-Frank needed? The lessons of the 2008 crisis A. The root causes of the financial collapse before 2008, the U.S. financial system operated with minimal regulation, allowing banks to make risky mortgage loans to borrowers who couldn't afford them, subprime. Lending. Package those loans into complex financial products, mortgage-backed securities, and collateralized debt obligations. Engage in high-risk speculative trading using customer deposits. When the housing bubble burst, these financial institutions were left holding trillions in worthless assets, triggering a global financial meltdown. The government was forced to bail out banks to prevent total economic collapse. B. The goal of Dodd-Frank. Never. Again, Dodd-Frank sought to fix the broken system by increasing oversight of banks and financial institutions, limiting risky behavior by banks and Wall Street firms, protecting consumers from deceptive financial practices. 2. Key components of the Dodd-Frank Act. A. Stricter regulations on banks and financial institutions. One of the biggest issues in 2008 was that banks didn't have enough capital to withstand financial shocks. When their risky investments collapsed, they needed massive government bailouts. Dodd-Frank changed this by requiring banks to hold more capital in reserve, ensuring they had enough funds to cover losses in a downturn. Undergo stress tests, simulated financial crises, to prove they could survive an economic shock. Submit living wills, outlining how they could be safely shut down without taxpayer bailouts. These measures aim to prevent another too big to fail scenario, ensuring that banks could not gamble recklessly with the economy. B. The Consumer Financial Protection Bureau, CFPB. Protecting the public, one of the biggest failures before the 2008 crisis, was the lack of consumer protection. Banks and lenders engaged in predatory lending, issuing high-risk mortgages with hidden fees and misleading terms, adjustable interest rates that started low but later skyrocketed, loans to borrowers who clearly couldn't afford them. The CFPB, Consumer Financial Protection Bureau, was created under Dodd-Frank to prevent this from happening again. What does the CFPB do? Regulates mortgages, credit cards, and payday loans, ensuring they are fair and transparent. Holds banks accountable for predatory practices, such as misleading loan terms. Helps consumers file complaints against banks and lenders. Educates the public about financial products, ensuring people understand what they're signing up for. Since its creation, the CFPB has recovered billions in fines from banks engaged in unethical practices. C. The Volcker Rule, stopping risky trading with customer deposits, another. Major issue in the 2008 crisis was that banks engaged in high-risk speculative trading, using customer deposits to make risky bets in the stock and bond markets. The Volcker Rule, a key part of Dodd-Frank, prohibited banks from engaging in this type of trading. How the Volcker Rule changed banking. Banks can no longer use customer deposits for speculative investments. Hedge funds and private equity firms cannot be owned by banks. Banks must focus on traditional lending instead of risky trading. This rule forced banks to return to their core function, serving customers rather than chasing short-term profits through speculation. D. The Financial Stability Oversight Council, FSOC. Preventing future collapses before 2008, no single agency had the authority to monitor risks across the entire financial system. Dodd-Frank created the FSOC, Financial Stability Oversight Council, to identify and address threats before they spiraled into crises. FSOC's powers. Identifies too-big-to-fail institutions that could endanger the economy. Requires additional oversight and regulation for risky financial firms. Monitors systemic risks across all financial sectors. This council acts as a financial watchdog, ensuring that dangerous bubbles don't build up unnoticed. E. The too-big-to-fail bailout prevention system, one of the most controversial aspects of the 2008 crisis was the government's decision to bail out failing banks. Dodd-Frank established clear rules to avoid future taxpayer-funded bailouts. The FDIC, Federal Deposit Insurance Corporation, gained the power to safely dismantle failing financial firms without disrupting the economy. This meant that no financial institution, no matter how big, could expect an automatic bailout. Impact and controversies of Dodd-Frank. Successes of Dodd-Frank bank capital reserves increased, making financial institutions more stable. Predatory lending practices declined due to the CFPB's oversight. The financial system became more transparent, reducing hidden risks. Stress tests helped prevent another collapse, proving banks could withstand economic shocks. B. Criticism and rollbacks. Despite its benefits, Dodd-Frank faced criticism. Banks claimed it overregulated the industry, limiting their ability to lend. Some financial institutions argued the Volcker Rule was too restrictive, preventing legitimate investments. In 2018, parts of Dodd-Frank were rolled back, especially for smaller banks, reducing their oversight requirements. C. The big question. Did Dodd-Frank prevent another crisis? While Dodd-Frank made the financial system safer, critics argue that loopholes remain and some banks still engage in risky behavior. The rise of cryptocurrency markets, fintech lending, and shadow banking could create new financial threats not covered by Dodd-Frank. The 2023 failures of Silicon Valley Bank, SVB, and Signature Bank raised concerns that some of the rollbacks weakened banking safeguards. 4. Final thoughts: the legacy of Dodd-Frank. The Dodd-Frank Act fundamentally reshaped U.S. financial regulation, making the system more resilient and transparent. It addressed the root causes of the 2008 crisis, ensuring banks hold more capital to survive downturns, don't gamble with customer deposits through speculative trading, can be shut down safely without taxpayer-funded bailouts, treat consumers fairly and transparently in lending and banking services. However, the future of financial regulation remains uncertain. With new financial risks emerging, some argue Dodd-Frank needs further strengthening, while others push for more deregulation. Beyond the US, other countries also tightened their financial regulations. In Europe, the Basel III framework was introduced to strengthen the banking system by requiring institutions to maintain higher capital reserves and limit excessive risk-taking. Governments worldwide pledged to increase transparency in financial markets, particularly in the complex world of derivatives and mortgage-backed securities. Did the reforms actually work? The impact and limitations of Dodd-Frank. The Dodd-Frank Act was designed to prevent another financial meltdown like the 2008 crisis, and in many ways, it succeeded. The financial system became more stable and resilient. Risky lending and speculation were curbed. Consumers received stronger protections against predatory financial practices. However, the law was not without its flaws. Critics argued that it didn't go far enough, that big banks still held too much power, and that Wall Street eventually found ways to undermine or weaken key regulations. Let's take a deep dive into whether these reforms truly worked and where they fell short. How Dodd-Frank stabilized the financial system. Banks became more resilient. One of the biggest dangers in 2008 was that banks were heavily leveraged, meaning they had borrowed too much and held too little capital to survive a financial shock. Under Dodd-Frank, banks were required to hold more capital in reserve to withstand downturns, undergo stress tests to prove they could survive a financial crisis, submit living wills outlining how they could be safely shut down without government bailouts. Did it work? Yes. Banks became safer, and major financial institutions are now required to maintain strong financial cushions to prevent another collapse. B. Consumer protections were strengthened. The Consumer Financial Protection Bureau, CFPB, cracked down on predatory lending and unfair banking practices. Before Dodd-Frank, lenders offered risky subprime mortgages with hidden fees and exploding interest rates. After Dodd-Frank, the CFPB forced banks to make loans more transparent and easier to understand. Did it work? Yes. The CFPB helped return fairness and transparency to financial markets. Since its creation, the CFPB has recovered billions in fines from banks engaging in deceptive practices. C. Banks could no longer gamble with customer deposits. Before 2008, banks used customer deposits to engage in high-risk speculative trading. The Volcker Rule, a key part of Dodd-Frank, banned this practice. Did it work? Partially. Banks stopped some risky behavior, but they found loopholes to engage in other forms of speculation, often through hedge funds or overseas subsidiaries. The flaws and shortcomings of Dodd-Frank. Too big to fail. Banks still exist. One of the biggest concerns before 2008 was that some banks were so large that their failure would destabilize the entire economy. Dodd-Frank was supposed to fix this by requiring big banks to have orderly liquidation plans. But in reality, the largest financial institutions are still massive. Did it work? Not entirely. Many of the biggest banks today, like JP Chase, Bank of America, and Citigroup, are larger than they were before 2008. If one of them collapsed, it could still trigger a major economic crisis. B. Rollbacks. And Wall Street lobbying. Weakened reforms. After years of lobbying by Wall Street, Congress rolled back parts of Dodd-Frank in 2018. The threshold for too big to fail oversight was raised, meaning some large banks no longer faced strict regulations. Stress test requirements were relaxed for mid-sized banks. Some parts of the Volcker Rule were weakened, allowing banks to engage in certain speculative investments. Did it work? Yes, at first. But in 2023, the collapse of Silicon Valley Bank, SVB, and Signature Bank showed that weakening oversight could have dangerous consequences. The rollbacks made it easier for banks to take on excessive risk without proper safeguards. C. New financial risks have emerged. Dodd-Frank was designed to prevent a repeat of 2008, but the financial system has evolved in ways it didn't anticipate. Shadow banking. Hedge funds, private equity, and fintech firms now operate outside traditional banking rules, creating new risks. Cryptocurrency. Boom. The rise of Bitcoin, stablecoins, and decentralized finance, DeFi, has created new financial vulnerabilities. High-speed trading and AI finance. Banks now use algorithms and AI to make split-second trades, which could cause unpredictable market crashes. Did it work? Dodd-Frank stabilized banks, but it didn't address newer risks that could cause future financial crises. The verdict? Did Dodd-Frank work? What it got right. Banks are more stable and less likely to collapse. Predatory lending was reduced, making mortgages and credit cards fairer. Financial institutions are more transparent with better oversight. What it failed to fix. Big banks are still too big to fail. Regulations were weakened over time, creating new risks. Emerging financial threats, crypto, shadow banking, AI finance, remain unregulated. Final thoughts. Is more reform needed? Dodd-Frank was a step in the right direction, but financial crises continue to evolve. While it prevented another immediate collapse, some underlying weaknesses remain. While traditional banking became more regulated, new risks began to emerge in other areas of the economy. One growing concern was the student debt crisis. As wages stagnated and college tuition skyrocketed, millions of young people took on massive amounts of student loans, creating a potential financial bubble. By the 2020s, U.S. student loan debt had surpassed $1.7 trillion, raising fears that this burden could slow economic growth and lead to future financial instability. Another evolving risk was the rise of high-frequency trading and algorithmic investing. Advances in technology allowed hedge funds and financial firms to execute thousands of trades per second, relying on complex algorithms to make investment decisions. While these trading strategies could generate massive profits, they also introduced new vulnerabilities, such as flash crashes, where stock markets could plummet within minutes due to automated trading errors. Is the world heading for another financial crisis? A deep dive into rising global debt and systemic risks. More than 15 years after the 2008 financial crisis, the world still struggles with debt, economic instability, and new financial threats. Despite lessons learned from the past, global debt has skyrocketed, financial markets remain fragile, and new risks, such as AI-driven trading, cryptocurrency, and shadow banking, have emerged. The big question: did policymakers truly fix the AI system after the Great Recession, or have they simply moved the risk elsewhere, setting the stage for another collapse? Let's take a deep dive into the current state of global finance and whether another crisis is looming. The alarming rise of global debt. Global debt has reached record levels by the mid-2020s. Total global debt surpassed $300 trillion, a record high. To put this into perspective, in 2008, before the Great Recession, global debt was around $140 trillion. By 2019, before COVID-19, it had grown to $250 trillion. After pandemic-related stimulus spending and borrowing, debt skyrocketed past $300 trillion. Why is this a problem? Governments, businesses, and individuals are borrowing at unsustainable levels. Higher debt increases the risk of defaults, which can trigger financial instability. If interest rates rise too quickly, many borrowers won't be able to repay their loans, causing a chain reaction of economic failures. B. Governments borrowed heavily to keep economies afloat. During the 2008 crisis, governments bailed out banks and used stimulus spending to keep economies from collapsing. During COVID-19, they printed and borrowed even more money to prevent a total economic meltdown. U.S. national debt surpassed $34 trillion by 2024. China, the EU, and Japan also accumulated massive debts. Developing nations faced even worse debt burdens, struggling to repay loans while their economies stagnated. Why is this a problem? If interest rates rise, debt becomes more expensive to repay, leading to higher taxes, spending cuts, and slower economic growth. Some countries may default on their debt, triggering a global financial crisis. C. Corporations and consumers are also over-leveraged. It's not just governments. Companies and individuals have taken on massive debt, often assuming that low interest rates will last forever. Corporations have borrowed trillions through bonds and loans to finance growth, buy back stocks, and acquire competitors. Consumers have racked up credit card debt, auto loans, and mortgages, expecting the economy to remain stable. If a recession hits or interest rates stay high, businesses and individuals may struggle to repay loans, leading to defaults and bankruptcies. 2. Have we truly fixed the system, or just shifted the risk? After 2008, new regulations, like Dodd-Frank, made banks safer, but financial risk didn't disappear. It just moved elsewhere. A. The rise of shadow banking and unregulated financial markets. Traditional banks faced stricter rules. So risky financial activities moved to less regulated sectors, such as hedge funds and private equity. These firms control trillions in assets but operate with little oversight. Cryptocurrency markets, the rise of Bitcoin, stablecoins, and decentralized finance, DeFi, has created new, unpredictable financial risks. Private lenders and non-bank institutions. Many companies now borrow from unregulated lenders, making it harder to track financial stability. Why is this a problem? If a shadow banking firm collapses, it could trigger a financial panic. Crypto and DeFi markets remain volatile, with sudden crashes wiping out billions overnight. B. The stock market's over-reliance on speculation and AI-driven trading. Since the 2008 crisis, the stock market has been driven more by speculation than actual economic growth. Tech stocks and meme stocks soared, even when companies weren't profitable. AI and algorithmic trading dominate markets, executing millions of trades per second, creating the risk of flash crashes. If markets panic, automated systems could trigger massive sell-offs in seconds, worsening financial instability. Why is this a problem? Stock market crashes can ripple through the entire economy, destroying wealth and confidence. AI-driven. Trading lacks human judgment, meaning market downturns could spiral out of control faster than ever before. C. Geopolitical tensions and supply chain. Vulnerabilities beyond financial risks. The global economy faces external threats. China-US. Tensions could disrupt trade and trigger economic slowdowns. Russia's war in Ukraine has caused energy and food supply shocks. Climate change disasters could disrupt economies and increase financial instability. Why is this a problem? A sudden geopolitical crisis could trigger a financial collapse, much like the oil shocks of the 1970s. Global supply chain breakdowns, like during COVID-19, could lead to inflation, economic stagnation, and debt defaults. 3. Are we headed for another global financial crisis? Experts are divided on whether the world is on the brink of collapse or if the financial system is more resilient than before. Reasons for optimism. Banks are better capitalized and face stricter regulations. Central banks have tools to stabilize markets in a crisis. AI and fintech innovations could create new economic opportunities. Reasons for concern. Global debt is at record highs and could become unsustainable. Unregulated financial markets, crypto shadow banking pose new risks. A stock market correction, recession, or geopolitical crisis could trigger another crash. Final thoughts. What happens next? The Great Recession of 2008 taught the world how fragile financial systems can be. Yet, despite lessons learned, global debt, financial speculation, and new risks have continued to grow. The key question: is the next financial crisis already brewing, or can policymakers prevent another catastrophe? The 2008 financial crisis reshaped the global economy and forced a reckoning with the risks of unchecked speculation, excessive debt, and weak regulatory oversight. But more than a decade later, many are left wondering, are we truly safe from another crash, or are we repeating the same mistakes? While the financial system has seen reforms, several warning signs suggest that another crisis could be brewing. One major concern is the continued rise of corporate and government debt. In the wake of the crisis, central banks kept interest rates historically low to stimulate economic recovery. This led to a borrowing boom, with corporations and governments taking on trillions in new debt. By the 2020s, global debt had surpassed $300 trillion, far exceeding pre-2008 levels. If interest rates were to rise suddenly or economic growth were to slow, heavily indebted nations and companies could struggle to repay their obligations, triggering another financial collapse. Another risk factor is the housing market and speculative investments. While regulations tightened after 2008, real estate prices have continued to soar, driven by investor speculation, low interest rates, and foreign capital inflows. In some cities, home values have reached unsustainable levels, raising fears of another housing bubble. At the same time, New financial products, such as complex derivatives, cryptocurrency investments, and high-frequency trading algorithms, have introduced fresh vulnerabilities that could destabilize markets. So, how can we prevent another financial catastrophe? The first step is ensuring responsible lending and corporate accountability. Banks and financial institutions must be held to stricter standards, preventing reckless lending practices and excessive speculation. Governments need to enforce existing regulations, close loopholes that allow risky behavior, and remain vigilant against new financial instruments that could pose systemic risks. Strengthening protections for consumers, such as increasing transparency in loans and credit agreements, can also prevent households from falling into unsustainable debt. Policymakers must also adopt long-term economic stability strategies. Instead of relying on short-term fixes, such as excessive government spending or artificial market boosts, leaders must prioritize sustainable growth, fair wages, and equitable economic policies. Diversifying economies and reducing reliance on speculative financial markets can also provide stability against sudden downturns. Financial literacy, your best defense against economic uncertainty. Financial security isn't just about government policies or corporate regulations, it's also about how individuals manage their money. The lessons from past economic crises have shown that those who are financially literate are far better equipped to weather financial storms than those who aren't. So, how can you protect yourself from economic downturns? Let's break it down. The power of financial literacy. Why it matters. Financial literacy means understanding how money works, how to save, invest, borrow, and spend wisely. It's about making informed financial decisions instead of taking unnecessary risks that could lead to financial hardship. Why is this important? Economic crises can happen at any time. Job losses, stock market crashes, or inflation spikes can wipe out savings in an instant. Many people live paycheck to paycheck, making them vulnerable when unexpected expenses arise. Without financial literacy, people fall into debt traps, taking on high-interest loans, credit card debt, and risky investments that can devastate their financial future. The bottom line: understanding money can mean the difference between financial security and financial disaster. 2. Key financial habits to survive economic downturns. Now that we know why financial literacy is crucial, let's explore the practical steps individuals can take to protect their financial future. A. Build and maintain an emergency fund. What? It is a stash of savings set aside for unexpected expenses, job loss, medical bills, car repairs, or economic downturns. How much should you save? Financial experts recommend 3 to 6 months' worth of living expenses. Where to keep? Store it in a high-yield savings account that is easily accessible but separate from everyday spending money. Why is this important? If you lose your job or face an emergency, you won't have to rely on credit cards or high-interest loans. It provides peace of mind, knowing you have a financial cushion during uncertain times. B. Avoid high-risk debt. Credit card debt, payday. Loans and high-interest personal loans can trap individuals in a cycle of financial instability. Interest rates on credit cards can exceed 20 to 30%, making even small debts grow rapidly if not paid off quickly. Student loans and car loans should be carefully considered. Avoid borrowing more than necessary. What to do instead? Pay off high-interest debt as quickly as possible. Prioritize loans with the highest interest rates first. Debt avalanche method. Use credit cards responsibly. Pay off the full balance each month to avoid interest charges. If in debt, consider debt consolidation or refinancing to lower interest rates. Pro tip: before making a large purchase with debt, ask yourself, will this put me in financial stress later? If the answer is yes, reconsider. C. Diversify your investments to reduce risk. Don't put all your eggs in one basket. A single investment, like a company stock, can crash overnight. Diversification spreads risk by investing across stocks, bonds, real estate, commodities, and other assets. Consider investing in index funds or ETFs, which track the broader market and reduce risk compared to individual stock picking. Why does this matter? In times of crisis like the 2008 crash or COVID-19 market downturn, diversified portfolios recover faster than concentrated investments. Even if one investment fails, others can balance out losses. Pro tip: If you're new to investing, start with index funds or robo-advisors, which provide diversified exposure with lower risk. D. Think long-term and avoid emotional investing. The stock market fluctuates, but historically, it trends upward over time. Panic selling during a market crash locks in losses. Staying invested is often the smarter move. Stick to a long-term financial plan rather than chasing short-term gains or reacting emotionally to market downturns. Why is this important? Many investors sold stocks during the 2008 crash or COVID-19 panic, only to miss the massive rebound that followed. Those who stayed invested and focused on long-term growth benefited the most. Pro tip: if you're tempted to make impulsive financial decisions, take a step back and review your long-term goals before reacting. How to stay financially secure, even in uncertain times. Now that we've covered the fundamentals, here's a quick survival guide for staying financially secure. Live below your means. Just because you can afford it doesn't mean you should buy it. Increase your financial knowledge. Read books, take finance courses, and stay informed about economic trends. Automate savings and investments. Set up automatic transfers to savings and investment accounts to ensure consistency. Have a backup plan. Consider multiple income streams, side hustles, or passive income sources. Stay calm. During market downturns, avoid panic-driven financial decisions. History shows that markets recover over time. Final thoughts. Financial security is in your hands. Economic downturns, market crashes, and financial crises will always happen, but how you prepare and respond makes all the difference. Ultimately, the 2008 financial crisis taught the world that economic bubbles can burst suddenly, and unchecked greed can bring down entire systems. Whether or not history repeats itself depends on the choices made today by governments, corporations, and individuals alike. The question remains, have we truly learned from the past, or are we sleepwalking into the next financial disaster? The video comes to a close. It's crucial to reflect on what history has taught us. The 2008 financial crisis was not just an economic event. It was a wake-up call. It exposed deep flaws in the global financial system, from reckless banking practices to inadequate regulations, and it showed how the collapse of a few institutions could send shockwaves through the entire world. But have we truly learned from the past? Or are we setting ourselves up for another crash? Financial history tends to repeat itself, often because people forget the lessons of the past. Economic bubbles, risky speculation, and debt-fueled growth have been recurring themes throughout history. From the Great Depression of 1929 to the I.com bubble of the early 2000s. Today we see warning signs once again: rising corporate debt, inflated housing markets, and speculative investments in new financial technologies. Are we on the verge of another collapse? Or have reforms and new policies made us safer? This is where the conversation turns to you, the viewers. Do you think another financial crisis is coming? Are governments and financial institutions doing enough to prevent it, or are we heading toward another disaster? Share your thoughts in the comments below. We'd love to hear your perspective. If you found this video insightful, make sure to like and subscribe to stay updated on more deep dives into history and economics. And if you want to learn more about past economic disasters and how they shaped the modern world, check out our next video on the Great Depression and its lasting impact on global economies. Click the link on your screen now.